Let's see. Hopefully we should be sharing screen right now. What's going on? That's interesting. Okay, here we go. Awesome. There we go. Okay. It's a little tense. All right, it is 6 o'clock and we are live with the scouting report. It's Tuesday, October the 4th. I can't believe we're already in the month of October. This year is going by really, really fast. Just some housekeeping rules real quick. If you are here in the chat, please make sure you put in the chat that you can hear me. I just want to make sure that as we're going through this, that everything is up to speed, that you can hear me correctly, because it would do me no good. It would do you no good if I delivered all of this information and nobody actually heard it. And we're gonna go over some things here. So just put in the chat if you can hear me. Just want to make sure we're good. All right, so I think we're good. Looks like people could hear me. Yeah. All right, cool. All right. So just really quick, my name is Dietrich Williams. I am a licensed realtor out of the state of California with Compass out of a community called Baldwin Hills. I've been in real estate for over the last decade and some change, probably closer to 2 decades. I can't believe I'm saying that. So I've seen a lot. I've heard a lot. I actually came into the market when the 2008 crash correction hit. So I've seen the highs, I've seen the lows, I've seen all of it. And so we're going to go over some stuff today just to get you up to speed. If you haven't been watching, or if you're just kind of a little bit confused, get you up to speed to what's really happening and what's going on right now. So you are probably like a lot of other people, and you are wondering, how's the market? This is a conversation that comes up between myself, my colleagues, and buyers and sellers alike, investors, renters, whatever. We get this comment or we get this question asked to us all the time. And so I really thought it was fitting to kind of put it into context. And I want to start off with this quote right here from Sam Cater over at Freddie Mac. He's the chief economist. He's one of the chief economists over there. So he said, the uncertainty and volatility in financial markets is heavily impacting mortgage rates. Our survey indicates that the range of weekly rate quotes for the 30-year fixed rate mortgage has more than doubled over the last year. But it's not just home buyers that this is really affecting, because this is having some effect on home sellers as well. So here's another quote from Mark Fleming, who's the chief economist over at First American Financial Corp, who said potential sellers are also facing economic uncertainty in addition to being rate locked in to their homes. I'll talk about that in a second. Yet when the economic uncertainty dust settles, those buyers and sellers who are on the sidelines will jump back in the housing game. Demographic trends support elevated purchase demand in the years to come. So it's a question of when, not if, for the housing market. So again, it's not just home buyers, it's also affecting home sellers as well. And you're probably hearing a lot of this kind of turbulence going on in social media, on the news. You're hearing it between friends. Other people are probably commenting on it. And there's a lot of uncertainty everywhere you turn. And I don't want to trivialize the angst that's going on, because a lot of people are nervous about what's going to happen when we hear words like recession and the stock market is dropping and foreclosure and debt and the Fed and interest rates going up and all of this kind of stuff. There's definitely some fear that's going on. And again, I don't want to trivialize that, but I do want to present you with the information so that you're armed and not acting from a state of panic, because let's just be honest, the news is going to give you all the stuff that's going to kind of hit you in that section and makes you want to panic. So then that's where the conversation goes. And the people that kind of give the most negative impact or the negative news or the negative forecast, those are the ones you typically see on the news all the time, right? There's a reason for that. So again, I don't want to trivialize anybody's fear, anybody's angst in terms of what's going on in the market, but I do want to provide you with just some information so that you can best prepare. So let's look at what's happening. Mortgage rates are on the rise. And so we see it in the news, we see it in the headlines. Mortgage rates are pretty much at really high levels right now. And when you take it into context over what's happened over the past couple of years, where we saw interest rates that are hovering really, really low, yes, interest rates would seem kind of high. But let's take a historic look at what's been happening with mortgage rates since, let's say since the 70s. So here is a trend line of really what I want you to pay attention to is the 30-year fixed rate mortgage. So this comes from Freddie Mac. They've been tracking this data since 1971. So if you look at the trend, you can see historically the highest interest rate that ever hit came back in October of 1981 at almost 19%. I couldn't imagine paying a 19% interest rate on today's home prices. It would definitely make home affordability almost impossible for anybody that's out there. But when we look at this on the average over the past, 40, 50 plus years, the average interest rate for mortgages has hovered close to around 8%. So 7.75%. And if you look at where we are today, 6.7%. Now this is kind of national averages. So it could be higher, it could be lower for specific lenders, but on average, the 30-year fix is right around 6.7%. Now, again, when you look at it from where we've been over the past couple of years, yeah, that's a little bit steep. So let's just kind of look at mortgage rates for, I would say, year to date, right? So year to date, we're looking at mortgage rates from the beginning of January up until now. And as you can see, there's been a sharp increase over those rates over the past several months. Particularly what we're looking at is mortgage rates being on the rise for the 6th consecutive week. So you see that spike where it goes from around 5.8% up to 6.7%. That huge spike is causing crazy turmoil off in the markets right now. And that's what you're hearing. That's what you're seeing right now. So as these rates are ticking higher, we just want to be cognizant of that, right? So again, it's not as high as the 19% that was back in 1981, but relative to where we were in the past couple of years, 6.7 seems just astronomical. So this really started happening. You can see rates at the beginning of the year were like, 3.2%. That was pretty low. But by mid-April, we were in the fives, and they've been steadily upticking since then. I think we hit roughly a high a couple of weeks ago at about 7%. We've since come down again. I'll talk about where we expect rates to go later on in this presentation, but we just want to kind of keep an eye on that, tracking that, and see how that's going to move. Now, that sharp increase again is causing a lot of uncertainty in the market, and especially for buyers who are just probably looking to wait it out at this point. So I have a lot of clients who are jumping off the fence saying, we can't do it, we can't do it, we can't do it. And I understand it. Again, I don't want to trivialize anybody's angst, okay? So when we talk about mortgage rates, and I'm going to talk about the Fed in a second, but what we've been hearing lately is mortgage or interest rates are up. The Fed is raising interest rates. Mortgage rates and the Fed rate don't necessarily correlate. Again, I'll talk about this a little bit later. What we really want to follow is the 10-year Treasury note. So the 10-year Treasury is really closely aligned to the 30-year fixed rate mortgage. So you see it in this chart. That kind of bluish gray section represents the 10-year Treasury. That kind of brown orangish line represents 30-year fix. When you look at them, they're kind of almost lockstep with one another. Now there's a spread that comes in between those. But as you can see, the trend lines pretty much operate in the exact same way. So the 30-year fixed and the 10-year treasury are very closely aligned. And that's the thing that we want to pay attention to if we're talking about interest rates on mortgages going up, is taking a look at the 10-year treasury. Now, when the Fed comes in and they do raise interest rates, it does have some trickle down effect. And we've seen that happen over the last couple of months because the markets get skittish. Investors get a little bit leery, and then lenders wind up kind of baking in this interest rate hike to their mortgages. So every time the Fed comes with an announcement, you can almost guarantee that mortgage lenders are baking that information into current rates. And so that's why you're seeing so much volatility that's going up and down. But what's really happening in terms of rates going up is roughly about a third of interest or of the rise in mortgages is really due to the blown out spread in the treasuries. So treasuries have been up and down consistently over the past couple of months. That spread is what's causing a lot of angst to happen in the market right now. So that's one of the big reasons why we're seeing interest rates uptick so much right now. Yeah. Okay. Yeah, I see you. So let's see. When we're talking about, really the economy, and the big thing that we're talking about right now is inflation, right? So that's the ugly kind of curse word that's being used right now. And so when we're talking about inflation, one of the key leading indicators of inflation is what's called the Consumer Price Index, or we call it CPI for short. Now, when we look at the CPI historically over time, it's hovered roughly around 2-3%, except in times of recession, where you can see that here in the chart and the graph. That grayish bar represents a time that we went through a recession, and then you can see the CPI drop down tremendously, almost down to zero. But over the past 40 years, we haven't had inflation up as high as we've had it, right? So right now we're at about 8.5%. And that's really crazy because, again, we've been hovering around 2% historically, because that's where the Fed wants to keep it at over the last 40, 50 years. Now, if these interest rates, or if these inflation rates continue to uptick, then the Fed is really going to step in. So I'm expecting to see probably Q4 2023, the Fed thinks that we're going to get this back down to about 2%, which will kind of release some pressure off of the economy. But there's some things that are going to have to happen. And I'm going to talk about some of this a little bit later, but I just want to set you up right now so that you understand what is happening in the market. So another leading indicator of what's happening in the market for the economy is what's called the consumer consumption, the personal consumption expenditure, or the PCE. Now, the PCE is somewhat similar to the consumer price index, but not really, because it's really measuring what people are spending on, right? So when the Fed is looking at how to curb inflation, one of the main things they're looking at is the PCE. And so the PCE comes kind of in different forms. I'll talk about that briefly. So there's core PCE and then headline PCE. So within core PCE, there's, what they do is they strip out foods and they strip out fuel, because those two things have the most price volatility, right? And so when the Fed is looking at this, they're looking at core PCE rather than headline, because they're stripping out, again, food and fuel. Well, those things have been kind of volatile over the last couple of weeks. So the Fed is looking at those a little bit more closely. So they're looking at both right now. And what does this mean for us, and how does this measure out? Well, this all has an effect on GDP, or gross domestic product. Now, just think of gross domestic product as you go to the supermarket, you have a basket full of goods, and whatever is being bought or sold, physical goods or services in that basket, that's what comprises of GDP. And we've seen GDP over the last 2 quarters decrease. And so the question is, and you've probably heard people say, we're in a recession. We are in a recession. By technical terms, part of what comes with being in a recession is that there's negative GDP for 2 consecutive quarters. And we've met that. However, there's another factor that comes into play with that, and that's that we need to have significant unemployment. So without that last piece, we're not really in the throes of recession. We're kind of there. But if unemployment is relatively low, barring everything else, we're not really in a defined recession. So kind of let's look at what's going on with GDP right now and what's driving it downward, because you can see over the last couple of years, it's been on the positive side, but in the last 2 quarters, we've shot negative. So what's leading to that? Well, we look at GDP being made up of basically 3 sectors: private goods, private services, and then government. Government is probably the smallest. It really doesn't have a major impact on GDP. But what does have a major impact on GDP is construction and non-durable goods manufacturing. So non-durable goods are things that are like made from paper, again, like food, different things like that, cleaning supplies, all that kind of stuff. Those have had a very drastic and negative impact on GDP and where it's going right now, particularly as it relates to construction. And why is that important? Because interest rates have been rising, which means for builders, their cost to build has been going up. You combine that with supply chain issues and supply shortages, and that's placed a really large, heavy load on construction. Now, I'm going to talk about this a little bit later and why this is important, that we're looking at construction and how it affects the economy. But if you scroll down to the bottom and you look at the things that are driving GDP, right? So I call those the 4 table legs at the bottom. Real estate is right at the head. I won't say it's at the head, but real estate is one of the main drivers of GDP right now. And it's pretty much always been that way. So as the housing market booms, typically the economy is booming. But if you have a table that has 4 legs and you saw one of those legs off, the table becomes unstable and it just might topple over. Well, if real estate takes a hit, that is a very big possibility of what can happen to the economy, is that the economy topples over. We go into a really hard landing recession. So we want to keep an eye on those things right now. So right now, the real estate market is hot, but we don't know. It's going through some price softening right now. I talked about construction and how that relates to particularly employment. But right now, our unemployment rate is at 3.7. Now it's up 0.2% versus July. And these are lagging indicators, right? So it's like a 2-month lag or a 1-month lag. And that's why we only have August information for unemployment. I think the next set of unemployment data is supposed to come out in the next couple of weeks, sometime in October. So I'll keep you posted as it relates to that. But again, are we in a recession? Not really, because employment's only shot up to 0.2%. That's not a significant increase in unemployment to basically put us into a recession. Now, if we look at unemployment year over year from August 2021 to August 2022, it's actually gone down. So in August 2021, employment was roughly at 5.2%. We were still dealing with some of the effects of the pandemic and people coming back into work. Right now, we're kind of past all of that, as everybody has gotten back to some sort of a sense of normalcy. If I can use that loosely, we've gotten back into some sense of normalcy, but we're still not out of the woods yet as it relates to everything with the pandemic and some of the stuff that's going on with the economy. So just keep that in mind. How does that affect the consumers though, right? So if unemployment is low, what we're also seeing is wages being high. Particularly at one point, there was a 2-to-1 ratio between jobs and workers, which meant that there were 2 jobs for every 1 person who was working out there. And because of that, and the Great Resignation and all of the stuff where people were like, I want to work from home and I don't want to do this job and I don't want to go back into services, employers were basically saying, hey, we will pay you to come in. We will pay you to stay. And everywhere you look, if you go to Best Buy, if you go to Target, if you go to Costco, if you go to Home Depot, you pretty much see we're hiring signs in the window. And that's because the labor force is short right now. But what does that mean in terms of the economy? Well, I want to put this in perspective, because I talked about the PCE, right? So consumer expenditures, and what's happening with expenditures. Well, here's a quote from Daniel Bachman he's the economic forecaster for Deloitte, which is a consulting firm. And he says, retail sales are likely to be further affected by declining demand for durable consumer goods. Durable consumer goods. Spending on consumer services is expected to grow as pandemic restrictions ease. So we're talking about consumer services in terms of like hotels, travel, vacationing, things of that nature. So remember, we're in an inflationary environment, but they're expecting sales to go up, which means people are still spending money. We'll talk about that in a second. So how does that relate to, again, to the economy? Well, let's look at personal income. It was up slightly, 0.3% from July to August. Now, that's not a huge uptick, but let's also look at spending. So spending was also up from July to August, 0.4%. Now, these are some things that are going to make you say, because the Fed is really trying to curb people from spending right now. And that's why they're raising the cost of borrowing by raising the Fed funds rate. So again, when they're raising the Fed funds rate, they want people to curtail it on spending so that there's not money floating around in the economy right now. And then how does this all affect mortgages? Again, when the Fed raises the Fed funds rate, there's no direct correlation to mortgages, but there's some trickle-down effect that's being felt. And so I want to read this quote from Nadia Evangelou, who's a senior economist over at the National Association of Realtors. And she said, the latest surge in mortgage rates means the market has reached a tipping point. Data shows that the typical family in the U.S. can no longer afford to buy a median price home when mortgage rates rise over 5.7%. We're at 6.7% right now. At that point, the typical family needs to spend more than 25% of its income on the mortgage payment. Now, your lender will tell you when you go to apply for a mortgage that amount, they want to keep it lower than 25% as much as possible. So you don't want a fourth of your income going toward your housing expenses, right? Because there's other things that you have to pay for. But as rates tick up, it becomes less affordable. So that drives us into looking at the Housing Affordability Index. Now, this index has a baseline of 100. And what that really means is that at the baseline, it means that the typical family earning the typical median income for the year can afford the typical median home mortgage at that price, right? Or at that income. The higher that index goes, the more affordable that mortgage is for that typical family. As it drops below 100, that means it's less affordable. So you can see that housing has been affordable for quite some time over the last couple of years. And that was really due to the record low interest rates that we were seeing. However, soon those interest rates begin to tick up. And remember, housing prices have been going up by double digits year over year. So you got high prices and now you have higher interest rates, which is making housing less affordable. Now, when you look at the chart, housing has been pretty affordable the whole time. However, you see that there's that dip below 100. That dip represented when interest rates hit 7%. So we just want to make sure that, again, we're keeping this all in context. And again, I'm not going to trivialize it, right? It's not that housing hasn't been affordable. It's just not as affordable as it once was. There are people still out in the market buying and selling real estate. They're buying homes, even at interest rates being close to 7% right now. And they're putting down 20%. So there's still people who are cash heavy and they're using kind of some of that, I would say some of that stimulus money that may still be floating around. They're using that and that higher wage growth to be able to make housing more affordable. So We talked about the Fed. We talked about how people are still spending. And this is something that the Fed is looking at, because if inflation keeps going up and what the Fed is doing is not working to try to keep people from spending, that's probably going to be another signal to the Fed that they need to be more aggressive in terms of raising the Fed funds rate and possibly pulling some other levers to curb inflation. So this is a quote from Ryan Sweet, who's the senior economist over at Moody's Analytics. And he said, since the Fed is signaling that it isn't going to stop raising rates until it tames inflation, I want that to sink in. The housing market will continue to be weak, with the potential it experiences its own recession. This isn't entirely bad news, as the housing market was red hot. So right now, the housing market is taking a little bit of a dip. You'll hear people say, and I've even said it, that we are going through a housing recession. It doesn't mean that there's a housing crash that's happening right now. What it means is that prices are beginning to stabilize. They're going back down to what we would call normal or balanced levels. So we're entering back into what's called a balanced market. This is a huge opportunity for people who are looking to buy right now. Again, I talked about earlier, sellers kind of being on the fence because they're rate locked in. So for homeowners who have had their homes prior to, I would say, 2021, many people decided to refinance. If they didn't already purchase, they decided to refinance to a lower rate. So some people were able to take advantage of those lower rates in the mid threes and the possibly like low fours. Right now, with rates being at 6.7, anybody who's selling has to do what? They got to buy again. So if they're buying again, they may be selling at a higher price, but they're borrowing at an even higher cost. So that is causing some home sellers to say, you know what, we're going to hold off and see what the market is going to do. And I don't blame them. It just as with home buyers, I don't blame you for sitting on the side. So again, let's talk about this Fed funds rate thing, right? Because the Fed, since I would say March, has raised the Fed funds target rate 5 times. 5. That's how aggressive they have been. The first increase was 25 basis points or 0.25%. Then there was a 50 basis point increase. And then the next 3 consequential increases have been 75 basis points. So the Fed funds rate has shot from 0.25, almost 0.25% up to 3.25%. So it's gone up 300 basis points. Now, the Fed funds rate, for those of you who don't know, I've talked about this in videos. The Fed funds rate is really the rate that banks borrow from one another. So for instance, I'm a bank, so I'm the bank of Dietrich, and you're the bank of Mr. and Mrs. Viewer. And the government says at the end of each day, you need to have a certain amount of money in reserves on hand at your actual bank. So what happens in the course of a day, I open up the bank branch, I have 100 people come in, and everybody's depositing hundreds of thousands of millions of dollars. I, in turn, as a bank, loan that money out to other people, consumers who want to purchase things like homes, cars, they want to get credit cards, take out school loans, all of that. So I'm loaning this money out at higher interest rates. Well, at the end of the day, I can look in and go, oh, shucks, I'm short. So I'm going to call you and say, hey, I need $1 million to meet my reserve requirements. Do you have it? And can I borrow it? And I'll give it back to you overnight. And you say, sure, I'll let you borrow it, because you know you're going to get your money back with interest. You're going to loan your money out basically for like 8 hours, and you're going to get 3.25% interest on the money I borrow from you. I don't know about you, but that's a sweet deal. I would love to lend somebody some money, and in 8 hours, they got to pay me back 3% interest. Who wouldn't want that gig? So that's the Fed funds rate. And that's really when you hear us talking about the Fed and raising rates, they're talking about the cost of borrowing from banks to one another. But that increase also gets passed down to the consumer, because the bank who is borrowing has to make up that cash from somewhere. And where do they make it up? They usually make it up by charging higher interest rates to borrow capital. So again, we're talking about the Fed funds rate. It has no direct correlation to mortgages. It just has some trickle down effect as lenders bake that in because investors in the market gets a little bit skittish. Now, I talked about housing prices kind of softening. One of the key indicators that we look at is the S&P CoreLogic Case-Shiller Home Price Index, or more commonly known as the Case-Shiller. So this looks at homes that were sold in a given period of time. It's not every home that was sold. It's homes that were sold and then resold. So for instance, it has to be an arm's length transaction, meaning that the person sold it doesn't know the person that bought it, right? So it's not family member has a home and they sell it to another family member. That's not an arm's length transaction. That's an arm in arm transaction. An arm's length transaction means that I sell something to you. I don't know you. You purchase it from me. We don't know one another. So they look at the turnover of these group of homes, and they basically base off of a model that these two economists put together, and it seemed to work. I don't understand the math behind it. I'm not a rocket scientist. I just know that they've been pretty spot on consistently for the last umpteen years. So the Case-Shiller Index looks at how prices are going to fluctuate up and down. Now, we take this with a little bit of grain of salt because this is a 2-month lagging indicator. That's why we only see the data coming out from July, right? So it updates, I want to say the last Tuesday of every month. So the last Tuesday of this month, there'll be some new information that comes out, but we see prices softening, even though that price index still hovers above 10%. We've seen prices softening, and you can see that in the market, and it's kind of a no-brainer, right? We know that that's happening because interest rates have creeped up, housing prices have been high, and from a supply demand issue, buyers are just like, I'm out. I don't want to deal with this anymore. I'm gonna wait it out. So homes are sitting a little bit longer if they haven't been priced right, and buyers are in a little bit more power position to create some negotiating power. So again, we're just seeing prices kind of taking a little bit of a softening effect as it relates to this. Where do we think home prices are going to go in the future? Well, I took a look at 7 of, I would say, some of the top companies who look at these forecasts. And for the most part, everybody is saying that we're going to be up. So Fannie Mae saying we're going to be up 4.4%, Freddie Mac 4%. The home price expectation survey has us up roughly about 4%. When we look at the Mortgage Bankers Association, they have us up roughly at 3%, 2% for NAR, and roughly around 2% for Goldman Sachs. Now you see this red bar that says Zelman. That is Ivy Zelman. She is a rock star analyst. She is one of the people who predicted the crash of 2008 coming. So she's been really good at reading and interpreting this data and being spot on with a lot of her projections. She's the one outlier in all of this. And real estate agents, we love Ivy Zelman because she gives us a lot of great information to use. She has been the one that's been extremely bearish on all of this as it relates to home price forecast for 2023, where she sees home prices dipping 3%. In some cases, it may be 3% or more, depending on the area that you're in. But it kind of makes sense, right? So if the Fed doesn't curb inflation, and we're already in pretty much heading into Q4, right? If the Fed doesn't curb inflation, then you can almost bet, everything else considered equal, that housing prices are probably going to take a little bit of a nosedive. Now, I'm one who wants to look at the glass as being half full, but I can't discount what Ivy Zelman is saying, especially because she's been spot on with a lot of other stuff. So I'm keeping that one in mind. I'm torn between the two because if you're a seller or a homeowner, you definitely don't want to see that. If you're a buyer, you love to see that because, again, that just creates some opportunity for you to be able to get into the market if you have not been in the market already. So let's see. I'm just going over some of my notes real quick. All right. That takes us back to, will mortgage rates keep rising? That is the $1 million question, and I wish I had a crystal ball to answer that question. But based on what the Fed is talking about and how aggressive they want to be and what I'm seeing in the data, and it suggests that the Fed is going to be more aggressive. So I assume that at the next Fed meeting, which will happen in November, If prices haven't cooled enough, if inflation hasn't cooled enough, if people are still spending, and if wages are still high, which in retrospect induces more spending, it's actually it's actually called lifestyle inflation. And it's a crazy theory, which essentially says that, hey, when people earn more money, they spend more money because they feel better, because they can now buy some of the things that they want. So the more money we make, the more money we spend, and it just keeps going on and on and on. Well, if that's happening, what tends to happen is we spend more. That means that demand is increasing. Well, we're having supply chain issues, right? So companies are having a hard time meeting supply issues, because they also have an increased borrowing costs, because a lot of them are leveraging in order to produce the goods and services that we are spending on. So if their spending has gone up, they have to pass that to who? The consumer, which means they raise their prices. So you see how that cycle kind of throws everything off. And in terms of what the Fed is doing, it makes it almost like a wash. So I'm predicting, actually, and we were thinking that the Fed was going to do this a couple months ago, that they're going to do, instead of a 75 basis increase in rates, they're going to go up 100 basis points in this next meeting. Now, again, this is all determined on what they're seeing with spending and income, as well as unemployment. So if those things aren't kind of leveling off and tapering in terms of what the Fed wants to see, then I can easily see this happening. But as far as it affects mortgage rates, we see that previously we had mortgages that were like 2.95, and that's because the Fed funds rate, again, was super, super low, down to like 0.25%. Well, if it raises up to 3.5%, and we're already at 3.25%, that's going to put some upward pressure on mortgage rates. Again, it's not a direct correlation, but lenders are baking those things in. And as we go forward, worst case scenario for 2023, because that's a best case scenario. Worst case scenario would be that they go a full basis point up, 100 basis points up. That's what I'm predicting in terms of what I think might happen, because of the way that the market is going and the way the economy is moving. If they do it 100 basis points, that's going to push us closer to 4.5. Now we're probably going to see interest rates maybe in the 8 range. It's not far-fetched. We just recently hit 7. Now that's tapered off and cooled, but when we're dealing with issues like the war in Ukraine, where we're dealing with issues like, the hurricanes that are sweeping the southeast. And I just want to take a time out and just let the people of Florida know that you guys are in our prayers. My dad is down in Florida. Fortunately, he left. He went to Baltimore. He got out of town. But there were people that weren't fortunate enough to do that. And so I just want you guys to know our hearts, our prayers are with you. Whatever we're able to do, we're definitely willing to do it. So again, I just want to make that known. But again, so as we go back, all of that stuff kind of puts a kibosh on the economy, right? So it adds to what's happening with inflation. So inflation continues to creep up. All of these things combined kind of have an effect on mortgage rates. And we can easily see that top 8%, depending on how aggressive the Fed is going to be in the next go round. So, like I said, the Fed is looking at these things very, very closely. And here is a quote from Jerome Powell, who is the chairman of the Federal Reserve Board. And he says, rate hikes will cause pain for the U.S. economy as growth slows and unemployment rises. A failure to restore price stability would mean far greater pain later on. And essentially what he's saying is, American people, stop spending, cut it out, because if you don't stop, we got to push in even harder. And what we don't want to do is cause a recession where we have a hard landing, but we're going to have to do something to make this thing slow down and stop. And so when the Fed is pulling those levers, they don't want to see a recession. They don't want to see unemployment. But if they can't curb that, they have no choice but to. So they push rates higher, make the cost of borrowing for companies higher. That in turn means that they have more overhead to pay. and they're already short staffed, so they're basically spending more on wages, on employee income. Well, if overhead increases and payroll is already high, they got to cut costs somewhere. Where did they cut costs at? They start laying people off, and that's where that massive unemployment rise kicks in at, and then we dip into the recession. So they're already expecting that unemployment is going to rise. And I talked about this earlier where I said, hey, our unemployment rate is only at 3.7%. It had a slight uptick of 0.2% from July to August. But the Fed is saying that we know unemployment is going to rise. How do they know this? Because they're planning on pulling the levers to make unemployment rise. And why is this important to you? Because there's economists that say there's a group of people, or two groups of people, who this is going to affect the most. Do you want to know who those groups of people are? They're people that look like you and me and brown people. That's right, Blacks and Hispanics. So when I talked about those two pieces of the private services sector that were affecting GDP, construction was right at the helm of that. Most construction jobs are held by Hispanic people. I won't say most. I want to say the number was roughly 40% of labor jobs in construction were held by Hispanic people. I think it's somewhere around 40%. I'll check the numbers and get back to you. But if construction is halting, that means they don't need people to work. People being out of work being Hispanics. That's kind of jacked up, right? But the Fed knows that this is coming. And this is why I'm giving you this information, so you can position yourself and understand, like, hey, do I have a stable job? What am I doing? This is the time to look at creating multiple streams of income and saving up and stockpiling as much cash as you can. Now, again, I'm not one to do the Chicken Little, the sky's falling, the sky's falling, but the Fed is essentially saying, this is what we want to do. I don't know how much clearer it can get than this, but the Fed is saying this is what we want to do. And if you look at the data, and I've showed you the data, I can see where the Fed is coming from, right? Because they're trying to taper this thing called inflation. We as the consumers, we're like, we're going to keep spending because we're earning more money. And that's driving prices a little bit higher. We saw that happening with gas prices when it came out. Now they dipped down, but recently they shot back up. So again, we're dealing with other issues that are affecting the economy. And somebody was asking me, like, why do you think gas prices went up? And I'm like, dude, when gas prices shot back up, it was just after Putin talked about, in the war with Ukraine, talked about nuclear weapons. Yep. Other countries were cutting off some of their petroleum and oil supplies to other countries. And remember, the U.S. is a big exporter of oil and gas. We don't really have all of that stuff. Now, that's going to change sometime in the future where we're not as dependent on that, because by 2035, I think, they will no longer sell gas running cars. If you still have one, cool. But by 2035, those things are going to be gone. California is supposed to lead the way in that. So it'll be California, Texas, probably New York. And as that goes, that decreases our level of need from other countries to supply us gas. Now, we're still going to need gas for other stuff because we still need oil to do other stuff. But for the most part, cars, 2035, that's going to be out. By the way, side note, if you are an investor, you might want to look at Tesla. Seriously, look at Tesla because it's probably a little bit more affordable now because stocks have taken a beating. This could be the chance for you to get in. I am not a stock advisor. I am not a financial advisor. Please take this with a disclaimer. I'm just giving you my opinion. It is solely my opinion that looking at Tesla might be a good deal, knowing that California, Texas, New York are probably not going to sell gas-powered cars, gas-fueled cars in 2035. Now, I talked about Hispanics. We talk about Blacks being probably the biggest group of people who are going to be affected by higher levels of unemployment. And that's just because of the sectors that we normally work in, the industries that we normally work in. And it's been like that historically. Blacks have always led the charge in unemployment. So when you look at what happened in the pandemic, Black unemployment was close to like 19%, something like that, compared to whites, which was at 14. So, and historically, when you look across the board, it's always been Black people who have been the most unemployed. I won't get into all the dynamics of that. I'll let you figure that out. But just know that the Fed is saying there's going to be a rise in unemployment, and economists are saying, yep, there will be, and it's going to affect Black and brown people. So take that for what it's worth. So again, one of the key questions people always ask, should I buy a home now or should I wait? And the answer really just depends. It could be a good time to make a purchase if you financially aren't in a good position to do that. So you have to ask yourself a couple of questions. You have to ask yourself, do you have a steady job? I just talked about unemployment and where it's probably going to go. If your job is steady, this might be a good time to buy, especially if you have decent income. It could be a good time to buy. Do I have a down payment and closing costs saved up? So down payment, you can get an FHA loan for 3.5%. Estimate closing costs are going to be about 2.5%. So do you have 6% of the purchase price saved up? If you do, you could be in a good position, again, to buy. How's your credit score? If you have a credit score that's below 700, then you probably want to work at that, because if interest rates are going to continue to uptick, you want to position yourself to get the best possible rate. One of the key factors in getting the best possible rate is your credit score. So you want to try to push your credit score above 740. I know you're probably like, Dietrich, my credit is jacked up right now. 740 is a stretch, but there's people that you can work with. Do your best. I'm not saying that it's the end all be all, but if you want to take advantage of the best interest rates, 740 or higher usually is the ticket to get you in at. The other piece of that is, what's your debt look like? Do you have little to no debt? So your FICO score, your credit score, and your DTI, or your debt to income ratio. So lenders are looking at those pieces of the puzzle. Your debt to income ratio is just essentially your debt divided by your income. They want to see that below 40%. Typically, if you get it somewhere around, like, I would say, I don't know, 30%, between 30 and 35%, that's ideal. All right. Put in the chat if you agree with that. Some people will say, no, 50% is cool. I can get a loan at 50%. You can, but you're not going to get the best rates and terms. So just know that working on your credit score, lowering your debt, is going to help you out tremendously. And then the last piece is, are you going to exhaust all your savings in order to purchase the house, right? So if you save up 60 grand and you blow all 60 grand to purchase the house, well, I'm not going to say blow 60 grand, because it's really an investment. You're investing in a home. I know there's some school of thought, and people say it's not an investment, you have to pay a mortgage on it. But historically, homes have appreciated in value over the long run. Now, if you're planning on getting in a home and moving out in 1 or 2 years, yeah, you're probably going to come in at a loss. But if you're going to stay in a home for 7 years or more, you're probably going to recognize some price appreciation, which means you're going to build some equity, and you can use that equity to go do other things to help build and sustain your wealth. So if you're going to exhaust all your savings, you may find yourself house rich and cash poor. And if an emergency happens, that could totally devastate you, right? And so that's why we just want to make sure that you're not exhausting all of your savings, that you're leaving some money in the piggy bank at the end of the day for a rainy day, all right? So again, the answer just really depends on what's going to happen, how mortgage rates are going to impact all of this. And if the answer to your question, to any of these questions is cool, you're good with that, it could be a good time to buy. I'm not going to say that now is the best time to buy, because that doesn't hold true for everybody, right? It's not an end all be all statement. For some of you, buying now makes the most sense. For the rest of you, renting and staying where you put makes the most sense. Now, just keep in mind, as housing prices have increased, so have rents. So I've had people come in and say, I'm going to wait, and then they will go to renew their lease, and their landlord is like, yeah, I'm increasing the rent on you. And now they're like, man, I could have just paid a mortgage if I'm going to pay this. So just keep all of that in mind if you decide that you're going to wait. All right. So wrapping this all up, what does this mean? What does this really mean for everybody that's out there who is looking to purchase a home, sell a home, any of that stuff? We're going to put it all together so that it really makes a whole bunch of sense. The economy goes through ebbs and flows. When it's weak, aka recession, inflation, anything like that, the Fed comes in, especially during in times of a recession. They print money. They actually do something like buy securities. So 10-year treasury notes, mortgage-backed securities, those are directly tied to mortgage rates. So they buy those, they put money into the market, the money's flooded with market, stuff goes well. But this isn't, it can't be sustained over the long run. Case in point, we're seeing it right now. When the pandemic hit, the Fed increased the money supply by doing exactly what I just talked about, and everybody had money, free money. We were just running around spending. Well, that pushed the demand up for certain products, and there wasn't enough supply. So because of that, prices rose, and now we're dealing with the throes of inflation. So when that happens, the Fed has to step in. They got two levers to pull. They can either start selling those securities, or they can raise the Fed funds rate to increase the cost of borrowing. The Fed has done one of those. They've stopped purchasing mortgage-backed securities. So that piece is stopped. And as we're going through kind of quantitative tightening right now, that's why we're seeing the market do what it's doing right now. So just know that that's how the Fed is doing that. So they're using these restrictive policies to curb inflation. But if they can't get it under control, like I said, then they got to be a little bit more aggressive. So it's like the different, and people are going to say, like, the Fed should just do this. The Fed just should just, if they do this, the economy will fix right away. I don't know about that, right? So it's like the difference between steering a, I don't know, a Chevy Spark and a cruise ship, right? Chevy Spark, little bitty compact car, you can steer that thing really quick. Well, a cruise ship, when you turn it, it takes a while for that cruise ship with all of that weight to turn and go the way that you want it to. Our economy operates like a cruise ship. So when the Fed is pulling these levers, it's not going to be an immediate fix, right? It's turning very, very slowly. But if they have to be more aggressive, it can make that turn happen a little bit faster. That's when the jolt hits, or what they call a hard landing. So you see increase in unemployment. You see all of this stuff happening that puts us in a recession, and we have a hard landing. They don't want to do that, but based on what I'm seeing in the data, I can see that happening. So you just want to keep all of this stuff in mind as again, we put it all together. How do you position yourself? Well, I just told you, save up cash, get your debt down, work on improving your credit, because during times of recession or during times where the economy is weak, this is where people who are financially savvy and in the know, they make their moves. And this is where millionaires typically get made at, right? This is where people who come in and they see the opportunity, they recognize the opportunity, they take it, they seize it by the horns, and they benefit from it in the long run. Now, again, I'm not saying that this is the best time for you to buy. It depends on what your situation is. But if you can do it, don't wait, because you may wait and decide, I'll wait till the market cools. And yes, housing prices may cool off a little bit, but what if interest rates shoot up to 8%? You'd have to have a tremendous decrease in prices to make up for that 8% interest rate making sense when you could have bought now as opposed to later. All right. So again, putting it all together, I just want to thank you guys for watching. If you like this information, please make sure you follow me so that you're notified, so that you're notified when I do this again next month and go through a lot of this information, because some of this information is going to come out again. Some of these indexes and some of these forecasts are going to come out in the next couple of weeks, some later on during the month. And we'll have to talk about this next month to see where the economy is heading. So again, folks, thanks for tuning in tonight. I really appreciate it. I wish you all the best. And I'll see you next